One of the main instruments, or like uh, I think I would say about more than 70% of the instruments that we issue are letters of credit. So we'll quickly dive into what an LC is. A letter of credit is a financial instrument issued by a bank on behalf of a buyer, normally the applicant, in favor of a seller who is the beneficiary. So it's a written undertaking by the issuing bank to pay the beneficiary, provided the beneficiary presents documents that are compliant with the terms and conditions of the LC. Okay, so in international trade, an LC reduces the risks for both the buyers and the sellers. So in simple terms, the buyers do not want to pay for the goods in advance because there's no guarantee that the seller will ship the goods after receiving the payment. And seller also wants a guarantee that they will be paid once the goods have been shipped. A letter of credit provides that guarantee to both parties. So practically speaking, cross-border transactions can be very tricky. And so most suppliers by nature or most sellers want to be paid before they even start shipping the goods or they even start production. And this becomes a major problem for buyers because one, they are not in the same country, and there's no way for them to actually know that yes, whatever they've paid for, they are guaranteed that the supplier will ship the goods. So this is why an LC comes in, and it gives comfort to both parties. It bridges that payment expectation gap. Okay, so that is what an LC basically does. Let's go to the next slide. Yes. So the parties involved in a first party letter of credit issuance. So there's the applicants, normally the buyer or the importer, and there's the seller or the beneficiary. They are also called the exporter, yes, in whose favor the LC is issued. And there's the issuing bank that issues the LC and makes payments upon the presentation of compliant documents. And there's also the advising bank. Okay. So the advising bank is the beneficiary bank. They authenticate and advise on the LC to the beneficiary. And there's also the confirming bank, if applicable. Okay, so think in the next two slides also we will explain what confirmation is. And so confirming bank, if applicable, yes, as its own independent payment undertaking to pay the seller upon the presentation of compliance documents. Next one. All right, where are we? Okay. So we're going to look at the different types of letters of credits. I'm sure most of you are familiar, but the purpose of this training is just to do a recap because most people come to us for some kind of clarification on some transactions, and it's important for us to do this training again. So there's LC at site or site LC. So under a side letter of credit, the issuing bank or the nominated bank pays the seller immediately at site upon the compliant shipping documents are presented. So a side letter of credit means that once the compliant documents are presented to the issuing bank to serve on the account holder, the issuing bank pays the supplier if those documents are compliant. So the standard procedure is that the buyer applies for the LC, the issuing bank opens the LC, the shipper ships the goods, present the documents to the issuing bank. The bank will then verify the documents, and if they are compliant, payment is released immediately, usually within 5 to 10 working days. So at TFCI and ATFCC, the payment of the goods is solely the responsibility of the buyer. A settlement is made outside the LC, so there's no presentation of documents to the issuing bank because we do not give acceptance. The next two slides will also explain the settlement outside the LC and the acceptance. And this is something I want us all to really focus on because most of our consultants or our brokers do not really understand this part, and then they cannot explain it very well to their clients. Okay, to the next slide. Okay. And there's also a Usance letter of credit, which is also called a deferred letter of credit. So it's commonly used when the buyer wants short-term credits under a Usance LC. The issuing bank or nominated bank promises to pay the seller at a future date within the deferment period upon presentation of compliant documents. So in a Usance letter of credit, normally when the supplier submits the documents to the issuing bank, they are not paid immediately. However, the bank promises to make the payment, and that is binding enough. And so it gives a period of it gives the buyer some credits whereby the buyer can sell the goods and actually raise the money within the deferment period to pay the beneficiary or the supplier. So at TFCI and ATFCC, we do issue Usance letters of credit or the first letters of credit, but then the buyer has to pay for the goods as sites. We will only release the goods to the buyer if the supplier will take the liability for the release and repayment of the goods. The site or deferred settlement is made outside the LC, so there's no presentation of documents to the issuing bank because we do not give acceptance. And I'm sure most of you still have questions. That's how is that possible? We will address that I think that in the next couple of slides. Let's go to the next one. Think we'll just do a quick recap because I'm sure most of these things you are familiar with, and most of you are in our community, and then you have access to the material. And then there's also a UPAS, which is a hybrid between a signed letter of credit and a Usance letter of credit. So UPAS basically means Usance payable as sites. Okay, so um, under a UPAS, right, even though the letter of credit is a Usance letter of credit, the supplier will be paid as a site and it comes as a loan to the buyer. So the buyer will open a UPAS letter of credit with their bank. The seller will ship the goods, submit the documents to the issuing bank. The issuing bank will then pay the seller or the supplier immediately as sites, and the buyer will then have to repay the bank at the end of the agreed credit period. Okay, so that is how a UPAS works. It's a hybrid of both the deferred and letters of credit sites. Let's move on to the next slide. Okay, and there's also a back-to-back letter of credit. Most of you come to us for back letters of credit, and I think some don't really understand how it works. So back to back is used basically when the supplier for the transaction is not the actual supplier, and then they are sourcing from the original supplier. So that supplier is more like a middleman. So when a letter of credit is issued to them, on the back of the letters of credit that their bank has received, their bank will then issue another letter of credit on the back of that one. So that's why it is back to back. Okay, all right. So let's say Mr. B is supplying sugar to Mr. A. Mr. B is getting the sugar from C. So when B receives the letter of credit, their bank on the back of that letter of credit will issue another letter of credit to Mr. C. Mr. C will then supply the goods to A, and A makes the payment to B, and B settles C. That's basically how it works. So here at TFCI and ATFCC, we do not issue back-to-back financial instruments because one, we only we only issue letters of credits or SBLCs. For us to do back to back, it means that we have to receive the LC and then we issue another one on the back of it. So back to back is something we don't do. But however, we can issue a new letters of credit to the original supplier to procure the goods or to secure the purchase. Also, if we issue a letter of credit to the beneficiary can actually get another instrument issued on the back of what we have sent, and that is entirely up to them. So that is how we treat back to back letters of credit here. We don't do it directly. We can issue when the beneficiary receives, they can then do the back to back on their end. Okay, so next one, moving on. Okay, and there's also confirmed. So confirmation basically means that after an instrument is issued, a second bank gives their guarantee that yes, They will make payments when the documents are presented. And so that is what confirmation means. So it means that a second bank as they add their independent, irrevocable payment guarantee to the issuing bank's undertaking, and this provides the seller or the beneficiary with double protection. Okay, it gives them more protection and more comfort. At ATFCC, we do not issue confirmed instruments. We do not confirm other instruments either. We do not have confirmation lines, and most banks will require cash margin plus charges before they add their confirmation. So confirmed instruments or LCs is something we don't do at all. Let's move to the next slide. I think I have to speed through this one. Okay. And then there's unconfirmed. All the instruments we issue at TFCI and ATFCC are without confirmation. They are unconfirmed instruments. Okay, so if the transaction requires a confirmed instrument, they will have to make that arrangement after we have issued. Okay, so all our instruments are without confirmation. Moving on to the next slide. Okay, and there's red clause, letters of credit. So it's a specialized letter of credit which provides a unique provision for the exporter, that's the seller or beneficiary, to receive an advance payment from the issuing bank before the goods are shipped. And this helps with pre-financing of the exports. Let's say to procure raw materials, fund production, and so on and so forth. So here at TFCI and ATFCC, we don't do red clause. And the name red clause comes because when it first started in the 20th century, this particular section was in red ink. So that's why it's called the red clause. And next slide. There's also the green clause. Yes. And so the green clause actually gives more protection. Okay, so under a green clause letter of credit, the supplier gets the pre-shipment financing. Okay, but unlike the red clause, um, these are essentially unsecured. But then with the green clause, the specific goods or warehouse receipts or collateral must be presented before the supplier can receive the advance. So green clause gives more protection, unlike the red clause. Also here at TFCI and ETFCC, we do not do green clause either. And there's also LC with bills of acceptance. So an LC with bills of acceptance is a type of letter of credit in which the seller presents a bill of exchange, a draft, along with shipping documents, and and the bank usually, oh dear, I think this statement needs some correction. Okay, I'll I'll explain. So normally, when goods are shipped by the supplier, right, the supplier will present the shipping documents along with bills of exchange or bills of acceptance. Okay, and so if the issuing bank reviews the documents and they are acceptable and then compliant, they will then accept the bills of exchange. And that is what we call the acceptance, meaning that they have agreed to make the payments either immediately or within the deferred period. All right. So an LC with bill of acceptance or bills of exchange, this is what it basically means. All right. So once the banker's acceptance is given, that becomes a negotiable instrument, sorry, and it can be discounted in the money market. Here, we do not give acceptance. If we talk about acceptance, this is exactly what we mean. We do not agree to pay for the goods. This is because the client coming to us has only given us a percentage of the face value of the transaction. That is not enough for us to bear the risk of paying for the entire cargo. Okay, so all our instruments are without acceptance. Our LCs and SBLCs, we do not give acceptance. Next slide. Okay, so LC without bill of acceptance, yes. So that's practically what we do here at TFCI and ETFCC. So acceptance is a type of letter of credit in which the seller presents bills of exchange along with shipping documents, and the bank usually accept the draft, promising to pay at a future date. But we do not give acceptance. The settlement must be made outside the LC between the buyer and the supplier. So when the goods get to the port of destination, the buyer must pay for the cargo before we release the goods and the shipping documents for them to take possession of the cargo. Next slide. Where are we now? Okay. So there's this chart here that yes, we prepared. So types of LCs that TFCI can issue. Okay, there's the LC type and the part marked green. It means that yes, we do issue those kind of instruments, and the red means that it's a complete no for us. So sites we do, Usance we don't do UPAS, we don't do back to back, we don't do red clause, we don't do green clause, we don't do confirmed. But any other one we do. Okay, so this will guide you. Okay, next slide. Okay. So first party instrument issuance process. Okay, I think this is important that you understand so that you know how our process is unique and different from the first party. So there is a sales contract. The buyer and seller enter into a sales contract. It could be a pro forma SPA or a contract of any form or kind. The buyer would then put in the application for the LC with their bank. They provide transaction details, beneficiary information, and so on and then so forth. The bank will then assess the buyer's credibility, and once everything is checked out with them, they will then approve the credit line for the client. And before that is done as well, the client will have to place cash cover or collateral to the bank for the bank to fall on as security to make payments on their behalf. Okay. And so there is the collateral element here. The buyer deposits cash margin or pledges collateral, and then the credit line will be approved. So in a first party instrument issuance process, the most important thing before the bank of the buyer or the client approves the credit line, the client needs to place cash cover or pledge collateral to the. Okay, yes, I'm back now. Yes, exactly. So after that, the letter of credit is drafted. The issuing bank will draft it as per UCP 600 regulation and ensure consistency with the underlying documents. And if there are any amendments by both parties, it's mutually agreed on. And then the letter of credit, the draft, sorry, is approved, usually by the beneficiary. So when that is done, then the issuing bank will issue the letter of credit either via Swift MT700 or MT710 to the advising bank. Next one, next slide. Okay, so the advising bank or beneficiary bank will verify the authenticity and then advise the beneficiary accordingly. And there's also the confirmation aspect, if requested and applicable. So a confirming bank will then add their confirmation. And after that, the supplier will mobilize their goods or start production, and they will ship the goods to the destination port. After that, they will present the documents to the issuing bank or confirming bank, along with a bill of acceptance or bill of exchange. The bank will examine the documents, and if it is satisfactory, the documents are accepted and payment is made on maturity or as per agreed terms. Okay, so when the bills of acceptance or bill of exchange is signed, the bank puts their signature and stamp on as accepted. It means that the seller is guaranteed payment on maturity date, and often they can discount the proceeds, the future proceeds, sorry, and then they can actually get some liquidity from that as well. So this is what we call acceptance in trade finance. Note here, acceptance under first party is possible because of the cash margin or collateral pledged by the client. So the bank is issuing, but they are not taking any risks here because the entire value of the letter of credit is secured either by cash or collateral, and that is what they fall on to make the payments once documents have been presented. Next slide. Yes. So we'll look at third-party LCs, which is what we do. This is our core business. Okay, so a third-party letter of credit is a letter of credit issued by an independent facilitator like TFCI or ATFCC on behalf of a client who is the buyer. The arrangement is typically used when the buyer is unable to obtain an LC directly from their own bank due to several reasons like insufficient cash margin or collateral or other credit or financial constraints. The facilitator leverages its own banking relationship and credit lines to arrange the issuance of the LC on behalf of the buyer. This enables the buyer to meet their seller's payment security requirements. So third-party facilitators charge an issuing fee for this service. So this is what our business is all about. We help clients that are constrained by several factors, okay, which actually puts them at a big disadvantage when they need to secure a purchase or a deal or a contract. They come to us and we leverage our banking relationship and credit lines to assist them for a fee. Next slide. So reasons why buyers need a third-party issuer. Banks normally require 100% cash margin or collateral. Okay, and there are some cases whereby some banks are unwilling to onboard new clients. Also, time constraints. I mean, if you're going through the normal banking channel, you need to go through their due diligence, their compliance, and that takes time before then the collateral cash margin must be placed before the credit line is approved. But coming to a third party, most third party issuers have the credit lines approved already. It is just a matter of the applicant coming to them, and when the applicant meets all the conditions and then the requirements, the issuance process is very fast. Also, some bank policies prohibit certain market sectors, or the structuring of some transactions are completely off the table as well. And for most businesses, liquidity is a very key issue that they find ways to balance it to their advantage. Putting collateral or cash margin means that their money is tied down for the entire period of the instrument's period of validity. Yes. So it presents a lot of liquidity challenges to most businesses. So that's one reason why they come to us. And also, most businesses want to scale up. And scaling up means that they need to buy big ticket sizes of goods and commodities. And so they are limited by presenting cash cover or collateral. So they come to issuers like ourselves, third party issuers, and then we assist them to do large ticket sizes or volumes and etc. Next slide. Next one. Okay, we're almost there. So parties involved in a third party LC. There is the third party issuer, of course. That will be a company like TFCI or ATFCC. So they assess the transaction and they agree to facilitate the issuance of the LC on behalf of the clients on the strength of their own balance sheets or through an investor account on behalf of the buyer. And there's also the buyer or the importer, and there's the seller, beneficiary, exporter, supplier. Yeah, so this is the party in whose favor the LC is issued. Okay, and there's the issuing bank, the bank that issues the LC on behalf of the buyer in favor of the supplier, the issuing bank, and also advising bank or the receiving bank. They authenticate and advise the LC to the beneficiary. And there's the confirming bank, if applicable, always if applicable, because The instruments that we issue are without confirmation. So if the client or the transaction requires confirmation, the buyer and the seller will have to make that arrangement completely outside of our procedure or our process. They will handle that on their own. Okay. So I think there's the confirming bank if applicable. Next slide. What are we working with now? Next one. Okay. So third party LC issuance procedure. I'm sure most of you have document procedures and the requirements. So in most third party issuance procedures, this is is the standard in the market. Yes, this is a standard practice. So of course, there's the underlying document, either the pro forma or the SPA, and the client will have to put in the application, fill in the application form CRS or KYC, or in some cases KYS as well, know your supplier. So all of these documents are presented, and then the third party facilitator will assess the transaction by undertaking due diligence on the counterparties, assessing the transaction viability, evaluating the risk, and finding a suitable issuing bank and issuing cost. After that, the LC is drafted. So the issuing bank will draft an LC as per UCP 600 regulations while ensuring consistency with the underlying documents. So let me just put this out there. There are so many clients and so many brokers that come to us, and they don't have any underlying documents, and they are requesting for a draft. We need to have the pro forma and or the SPA or both before we can even start analyzing or assessing the transaction. Without the underlying document, it will be impossible for us to issue a draft. Okay, so moving on. So once we have issued a draft, yes, the draft has to be approved. Okay, and so that is the sole responsibility of the beneficiary, seller, or the exporter. They'll first run it through their bankers. Once their bankers approve, they'll stamp and sign, and the buyer will also do same on all pages. Okay, so once the draft has been approved, then it will move to the payment of the issuing fee. Okay, here at TFCI and TFCC, we have several payment options. I'm sure most of you have our payment options documents. So whichever option is preferable to the buyer or client, they will opt for that one. And once the fee has been sorted out or paid, then we will instruct the issuing bank to issue the LC via either SWIFT MT700 or MT710 to the advising bank. Advising bank will receive the SWIFT, verify the authenticity, and advise the beneficiary. And then we move to shipment. The beneficiary will ship the goods to the port of destination. Then it comes to the acceptance and settlement. Okay. And this is very important. We talk about it all the time. So under a third party LC arrangements, the issuing account party does not give acceptance or reimbursement obligation under the LC. This is because the buyer has not provided any cash margin, collateral, or any other security to the third party issuer to support settlements. Okay, client has only paid us a small fraction of the transaction value. Our instruments serve a purpose to facilitate the movement of the goods from the supplier to the buyer. It acts as a conduit to give that comfort and confidence to the supplier to ship the goods. But the settlement part, that obligation does not fall on the third party. So we don't give acceptance, and the settlement of the cargo is not our responsibility. It doesn't fall within the remits of our liabilities at all. So normally we hold on to the goods as collateral. Once the payment is made, only then will we release the goods and the shipping documents for the client to take possession. Next one. Yes. So the primary purpose of the third party LC is to serve as a trade guarantee rather than a funding or capital deployment instrument for payments for the cargo. The buyer leverages the creditworthiness and banking, their creditworthiness and banking relationships of the third party issuer to enhance buyer's credibility and provide payment assurance to the seller. Note that under this arrangement, settlement of the commercial transaction is made outside the LC. The buyer and the seller have a separate contractual payment arrangement regarding the trade. Under this agreement, the beneficiary or the seller is not expected to present shipping documents or a bill of exchange to the issuing bank to demand payment under the LC. The third party LC is intended solely as a documentary guarantee and not a mechanism for settlement. All right, next slide. I think we have, okay, so the differences between first party and third party. We'll look at some aspects of these two constructs, and then we outline the differences, or we isolate exactly what each responsibility is under the captions, I would say, yes. So the relationship under a first party issuance, which is normally collateralized. Okay. So it is a direct relationship between the bank and the customer. Usually it is the buyer's own bank. Under a third party issuance, uncollateralized, yes. It is indirect. There are multiple parties. There's the buyer, the third party issuer, and the seller. So it is normally issued by a bank arranged by the third party provider. And there's the element of collateral. Typically requires collateral, and I mean for the first party, typically requires collateral from the buyer. It could be in the form of cash, assets, credit line, etc. Sorry. And under a third party, talking about collateral, it's more transaction backed and there's no collateral involved. Normally, the goods that are being traded acts as a collateral for the transaction. The typical use. So in a first party, the importer uses its bank's credit line. Under a third party, the clients need, oh, I need to look at the wording of this one. Clients need access to trade finance capacity beyond their direct banking arrangements. I think we'll review that particular line. Yes. And also there's the credit assessment. So under a first party, the credit assessment or the credibility of the client is based on the buyer's balance sheets and their own credit worthiness. So if they are not good or they don't have the credit line, it means that they are limited and the transaction is short right there. But under a third party, the client can assess the creditworthiness of a third party and their balance sheet as well. And it allows scalability to do bigger volumes. So that's for the credit assessment. And next slide, let's look at that. Okay, cost, yes. So I think I'll give some more explanation to this one. Under a first party, the client provides collateral cash cover or any form of near money assets. Exactly. And normally the issuing fee is low, about 1% or lower. Most people think that the cost is lower, but it comes at a greater cost to the buyer in the form of required cash margin, which may significantly affect their operational liquidity. Okay. So if you compare the two, some might think that the issuing cost in the first party is cheaper, but there's a greater cost, which is the collateral, the cash margin, and so on and so forth. In the third party market, overall, it is cheaper because the buyer only pays an issuing fee and does not need to provide cash cover or pledge any collateral. It's purely uncollateralized to the client, but the third party is taking that responsibility and has the credit lines already. So the third party is cheaper overall. Okay, but if you're looking at the issuing fee, one might think that the first party is cheaper, but third party issuances are overall cheaper. So the speeds in the first party is normally slower because the bank will then have to go through their due diligence, the collateral pledging, the assessment and approval, which takes weeks, sometimes months. But in a third party, it is faster simply because the credit line is available. The only thing needed is for the third party to complete their requirements. And once the fees is paid, in a matter of days, the LC or the SBLC, the instrument can be issued. So it is faster in the third party market. Also, we're looking at flexibility. In the first party market, there are a lot of constraints by bank policy, jurisdictional limitation, and sector limitations as well. There are some banks that do not do business with some countries directly or indirectly, and there are some sectors that they don't do. Some gas don't, some banks, sorry, don't do gas or fuel, and then some banks don't do gold, some don't do paper. There are so many things. So there is a limitation, but in the third party market, because the client has access to different banks, there's more flexibility to do more products or commodities, and the structuring it gives room for a lot of structuring to address limitations that normally occur under a first party issuance. And there's also the risk allocation. So in the first party issuance process, the bank absorbs the credit risk, whilst the buyer absorbs the seller's performance rate. Both of these liabilities are fully backed by the buyer's pledge, collateral, or cash margin. What it simply means is that whatever that is involved in a first party, it's it is hinged directly on the cash margin or the collateral that has been pledged for the credit line to be approved. So, and also in the third party, the facilitator bears the transaction risk and uses the goods as collateral. I think there's one more slide to go. Next slide. Next slide. Okay, yes, that's it for now. So, let me also talk about the